infrastructure has performed just about as we would have expected. Infrastructure is really a series of different subclasses. So the sectors that are the most secure, the least impacted by the economic cycle, such as regulated utilities and urban toll roads, what we saw is that the global financial crisis had virtually no impact on those businesses. They continued to grow their earnings, they continued to grow their dividends. For some of the other parts of the sector that were a little bit more exposed to the economic cycle, such as airports and ports, we did see some impact from the global financial crisis. We did see in some airports passenger numbers going down, but we did also see through most of that period the ability of these assets, because of the leverage they've got, to continue to grow earnings. So fundamentally what we saw through this period was that the sector has been able to continue to grow earnings and to continue to grow dividends, and that's much as we would have expected, because it's a very robust sector, it's a very defensive sector. In the boom times, this sector will generally underperform other sectors, but in the rocky times like we've been through, it's a sector that really comes into its own. Let's take a couple of the stocks that we've invested in overseas. Enstar's a utility. It's based in Massachusetts in the United States. It provides electricity and gas for people there. It's just paid its 475th consecutive dividend. It's just had 16 consecutive years of earnings growth. It's the only company in the S&P 500 or Fortune 1000 that's had 13 consecutive years of earnings growth. Another example would be Consolidated Edison, which provides the power to the island of Manhattan. It's just had 35 consecutive years of dividend increases. So that's good examples. There's toll roads around the world, we're seeing continuous growth there as well. So these assets, as we see, are very rarely impacted either way by the economic cycle. Well, the global financial crisis hit all asset classes, and infrastructure wasn't completely immune from that. The share prices were impacted. And that was partly because a lot of these assets do have, by industrial company standards, quite high levels of debt. But these levels of debt have been around for decades in most cases, because these assets have got very robust, very secure cash flows, and they can support that level of debt. So there was some of these stocks that I've just talked about, you did find that their share prices were impacted. It created some wonderful buying opportunities for us, and now we've seen fairly strong recoveries, and they're back to where they were pre the financial crisis in most cases. Well, the outlook for the sector, I know it sounds a bit boring, but boring's not a bad thing to be right now, is that it's likely to be much of the same. The regulated utilities will continue to be there. They're very much needed these days for green power and making sure that we can interconnect all the green power, the wind farms and so on that are going to be built. We're seeing continued resilience in the toll road sector. In these sectors that are a little bit more exposed to the economic cycle, like airports and ports, we're starting to see a rebound in numbers there. We did see, for some airports, passenger numbers drop down into the negatives last year, although I have to add that earnings continue to grow through that period, and now we're starting to see some really good growth. So this is a sector that is going to perform in just about any market, and we look forward to the next 12 months as being a very solid performance out of this sector. There is actually quite a big difference between the global infrastructure and utilities sector and in Australia. The differences are twofold. Firstly, the overseas sector has been around a lot longer and is generally much less geared than what you've seen here. So we really, if you look globally, you've seen few, if any, infrastructure and utility companies have any problems with debt levels or raising new levels of debt. The other thing that you do not see overseas, you don't see the managed funds such as we've had here, the Babcock and Brown and the Macquarie type vehicles. They're all well-established companies. They've got balance sheets and P&Ls that work. They're companies that you can understand, and the companies that are very different in structure. They pay their dividends out of cash flow. They're very different in structure to what we've seen here.